Greetings traders, and welcome to another episode of AM Trading. In this installment, we will delve into the critical concept of liquidity, which can significantly enhance your trading performance. By gaining an understanding of liquidity, you can make more informed decisions regarding entries and exits, reduce your losses, and identify favorable risk-to-reward opportunities. This video will provide an in-depth explanation of liquidity from a smart money trading perspective. We will explore the various liquidity movements and demonstrate how to apply this knowledge to the charts. Additionally, we will introduce a key, rule-based liquidity trading strategy with specific entry and exit points. So what is liquidity? Liquidity, in essence, refers to the availability of money in the market, which enables ease of trading for large players. When a transaction takes place, it involves both buyers and sellers. High liquidity in the market means that there is more money available for trading, making it easier for big companies to execute their transactions without affecting the market price. On the other hand, low liquidity can cause market prices to skyrocket, which is undesirable for large players as they don't want to increase the price but instead they want to buy it cheap. Therefore, they need liquidity or sellers in the market to avoid such situations. Now, how do we identify liquidity zones? Liquidity zones can be identified as areas where retail traders become involved in the market. For example, when the price reaches a demand zone, traders may start placing buying orders, which creates liquidity. In this scenario, small banks, private institutions, and other entities could also place buying orders, which further enhances liquidity. By placing their stop losses below the demand zone, traders create a liquidity zone, where the big players can grab liquidity, leading to a sharp upward movement in price. Similarly, when the price reaches a major level of structure that has acted as both support and resistance multiple times, it creates a perfect trading opportunity. Grabbing liquidity in such scenarios enables the price trend to continue, which is highly desirable. In summary, identifying liquidity zones and understanding how they function is crucial to successful trading. The identification of liquidity zones on the chart offers several benefits for traders. Firstly, recognizing an existing liquidity zone before a demand or supply area provides a perfect trading opportunity as liquidity acts as fuel for the desired market movements. Secondly, distinguishing liquidity areas with a lower chance of success from major demand and supply zones can help traders to promote their entries and reduce the number of losses incurred in trades. For instance, a break in the structure level leaving behind a perfect order block can be an excellent opportunity to place buy orders. Moreover, by observing how many times the price creates liquidity zones after a sharp move, traders can determine the trend's exhaustion level. Grabbing liquidity before reaching an order block is generally a perfect trading opportunity, but it is not an absolute rule, as price fluctuations can lead to a major trend change. Therefore, traders should always look for a reversal pattern on lower time frames before placing trades. Now, there are various types of liquidity zones such as trend lines, consolidation areas, major moving averages, etc. However, it is essential to keep things simple and focus on identifying liquidity zones based on equal highs and lows for ease of use and benefit. In the example given, the major supply and demand levels are distinguished from liquidity areas. The inefficiency created by opposite color candles can be a perfect demand or supply level for trading. The major level of structure acting as both support and resistance is also a perfect trading opportunity for buyers. Having gained a thorough understanding of liquidity, we shall proceed to delve into our pivotal liquidity trading strategy. However, before we commence, we kindly request that you express your appreciation of our content thus far by liking and subscribing to our channel, as it would be immensely beneficial in facilitating the production of similar educational videos. This particular trading approach is not constrained by any specific time frames and may be applied in various markets, including Forex, crypto, and stocks. It comprises two fundamental steps. Initially, the trend is identified, which can be done in multiple ways. One simple approach is to employ a trend line, which links two or more price points and can assist in determining the trend's direction. An upward trend is created by connecting higher lows, whereas a downward trend is created by connecting lower highs. Another method for identifying the trend is to use moving averages. Moving averages can help smooth out price fluctuations and offer a visual depiction of the trend. Traders may utilize different time frame moving averages, such as the 50-day or 200-day moving average, to identify short-term or long-term trends. So from this chart we are able to identify the trend, which is an uptrend, and we will only look for buying opportunities. Secondly, we look for a liquidity sweep pattern. This means we wait for the price to make a support and either wick below the support and grab the liquidity, or close below the support and get back above it. For example, we can see a long wick candlestick forming below a support level, which indicates that the market made support and grabbed the liquidity. After this candle, we can either enter the trade or wait for a confirmation candle that closes higher than the previous one. Our stop will be placed below the long wick candlestick, and we will target the next level of structure. We can also consider closing half of our position when the price reaches the 1 to 2 target, thereby making our trade break even. An important point to keep in mind is to always look at the higher time frame to see where the price is and how much room it has to reach the next level of structure. For example, if we zoom out to the 1-hour time frame, we can see that the price has recently broken the structure to the upside and has ample room to go until it reaches the next level of structure. Additionally, if it breaks the low to the downside, we will look for shorting opportunities in the lower time frame until it reaches the next level of market structure. It's worth noting that everything we've discussed thus far applies to the bearish scenario. In summary, this liquidity trading strategy involves identifying trends using the EMA of 50 periods or trend lines, waiting for liquidity sweep patterns, and always keeping an eye on the higher time frame to gauge the price's potential. While this strategy is not limited to any particular market or session, it's advisable to conduct your own backtesting to determine which parameters work best for your individual trading style. Like always, if you like this video or find this video helpful, don't forget to hit the subscribe and like button, and we will see you on the next episode of AM Trading.